Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Thursday the 11th of April. I have today's business and finance news from across Asia for you as we edge our way towards the end of the week. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And here are the things you need to know in today's business headlines. Consumer prices in the US rose faster than expected last month, in a sign that the fight to slow inflation has stalled. Prices rose 3.5% over the 12 months to March, up from 3.2% in February. On a monthly basis, the consumer price index rose 0.4%. Economists have been looking for a 0.3% gain and a 3.4% year-over-year level. Higher costs for fuel, housing, dining out and clothing drove the increase, with petrol and housing costs accounting for more than half the rise. While Fed officials still believe they remain broadly on track to hit their 2% inflation goal, the minutes of the FOMC's March vote, published on Wednesday afternoon, showed factors ranging from higher oil prices and housing costs to looser financial conditions, posing upside risks to that base case. Policymakers expressed the view that recent data hadn't increased their confidence that inflation was moving sustainably down to 2%. Fitch Ratings cut the outlook on China's long-term foreign debt to negative from stable, citing increasing risks to the country's public finance prospects. Rising economic uncertainties and China's efforts to shift its growth model away from one driven by the property market have eroded fiscal buffers from a ratings perspective, the rating agency said on Wednesday. Fiscal policy is increasingly likely to play an important tool in supporting growth in the coming years, which could keep debt on a steady upward trend, it said. South Korean President Yoon Suk-yeol suffered a major defeat in parliamentary elections in what is widely seen as a midterm referendum on his administration. Mr. Yoon's Conservative People Power Party bloc is poised to secure about 105 seats in the 300-seat National Assembly, down from 119 before the vote. The opposition Democratic Party bloc is set to expand its majority with about 172 seats, according to more than 95% of ballots counted by the National Election Commission as of this morning. The DP group held 169 seats before the vote. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Hong Kong-based macro strategist Patrick Bennett. With a view from Singapore is Geoff Howie, market strategist at the Singapore Exchange. And if you have any comments on the show or want to ask my guests any questions, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wednesday on Wall Street, US stocks and treasuries sold off after higher than expected inflation in March led to traders slashing expectations for interest rate cuts this year. Investor sentiment was further dampened following the release of March's Fed meeting minutes, which reflected officials' concerns that inflation isn't moving quickly enough towards the Fed's 2% target. The S&P 500 index closed 1% lower at 5,161, with 9 out of 10 stocks in the red. Every sector declined except for energy, which was helped by a rebound in the price of oil. The interest rate-sensitive real estate sector fell over 4%. The Dow dropped 422 points, or 1.1% to 38,462. The Nasdaq Composite tumbled 0.8% to 16,170. Yields on 2-year and 10-year treasuries leapt to their highest levels since mid-November following the release of the inflation data. The yield on the 2-year note jumped 22 basis points to 4.97%. The 10-year treasury yield ended the session 18 basis points higher at 4.55%, and that was the biggest yield jump for the 10-year note since September 2022. The US dollar index surged 1% to 105.2 on Wednesday, its highest close since November 2023. The yen fell 0.9% against the dollar to 153.17. That's its weakest level since July 1990. In Shanghai, the yuan was unchanged at 7.2340 renminbi per dollar, ahead of Chinese inflation data due out this morning. The price of gold fell 0.9% from Tuesday's record high to $2,332 an ounce. Brent crude oil settled 1.2% higher at $90.52 a barrel, and on the mainland, stocks slipped to near 2-week lows. The Shanghai Composite fell 0.6% 0.7% to 3,027. Hong Kong stocks were the outperformers Tuesday in Asia. The Hang Seng surged 311 points. That's 1.9% to 17,139. And the move has reversed early year losses and put the city's benchmark index into positive territory for the year. That's going to change though this morning. Futures markets pointing to a decline of about 1.4% for the Hang Seng, projected to open 235 points lower, just above 16,900 when trading gets going this morning. You can get more details on the latest market movements, which you'll find in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests on this Thursday morning. We have our regular Thursday morning commentator, Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning, Peter.
And also with us is Patrick Bennett, who is a Hong Kong-based macro strategist. Nice to speak with you again this morning, Patrick.
Thanks, Peter. Good morning.
Let's start with this US inflation data. Jumped more than expected as fuel and housing costs rise. Consumer prices in the US rose faster than expected in a sign that the fight to slow inflation has stalled. Prices rose 3.5% over the 12 months to March. That's up from 3.2% in February, the US Labour Department said. On the monthly basis, the consumer price index rose 0.4%. Economists had been looking for a 0.3% gain and a 3.4% year-over-year level. Higher costs for fuel, housing, dining out and clothing drove the increase, with petrol and housing costs accounting for more than half the increase. Energy rose 1.1% after increasing 2.3% in February, while shelter costs, which make up about one-third of the weighting in the CPI, were higher by 0.4% on the month and up 5.7% from a year ago. And core inflation, which excludes more volatile food and energy prices, stood at 3.8%. That's the same as in February, compared with economists' expectations of 3.7%. Core CPI also accelerated 0.4% on a monthly basis. That's compared with estimates of 0.3%. And finally, the so-called supercore inflation reading, which measures services inflation, excluding food, energy and housing, has also roared higher. It's up 4.8% year over year in March, the highest in 11 months. Andrew, let me ask you to kick off here and give your thoughts on this data. Is inflation becoming entrenched here?
Well, Peter, actually, I am bored of repeating the same thing, which is hardly a Nobel Prize winning observation, that since June last year, 10 months ago, and it's coming up to 1 year now very quickly, the inflation, the CPI inflation in the United States has the number 3 permanently fixed in front of that. Now, if that's not an unmoving trend, I don't need to, as I said, I don't need to get a PhD in statistical economics to tell you that that thing ain't no moving. So very early on, after 3 or 4 months of the 3 being there, and incidentally, the 3 point is all over the place. Very quickly, I'll give you just the numbers. The 3 point, 0, 2, 7, 7, 2, 1, 4, 3, 2, 5. The decimal thing is completely all over the place, thereby emphasizing that there is no trend. Definitely there is no trend downwards. So a flat trend in inflation is possibly one of the worst things that the Fed can actually expect. So I'm not surprised they're not going to cut.
So
my forecast now has moved to about perhaps 1 cut towards the third quarter of this year.
So really, from what you're saying, look not just at this month's data, but the previous couple of months as well, previous few months, inflation is becoming entrenched.
Yeah, absolutely. It doesn't need a great degree of quantitative savvy to say that doesn't look as if it is going anywhere. Particularly, I'm particularly obsessed with the decimal bit that just refused to assume a trend. For it to be 3.9, 3.8, 3.7, 3.6, to say, look, it's coming down. It isn't.
Patrick, perhaps I can suggest that actually it's even worse than the 3% here that Andrew's mentioning in those data, because if you take this supercore inflation rate, which is a measure really of services inflation, ex sort of energy and transport costs, if you analyse it over the last 3 months, you get to 8%. I mean, that's not going to keep the Fed happy at all, is it?
No, not happy at all. And look, I very much agree with Andrew, and I think we've said the same thing on this conversation previously. Whether it's entrenched, whether it's sticky, whether it's persistent, it's all of those things. For me, from a market perspective, what's been very surprising is how fascinated the market has been collectively to look for this, to pursue this idea that the Fed's about to be cutting rates. Whether it's up 1/10 or down 1/10, as Andrew quite points out, that the decimal is still on the 3 handle. The headline's still on the 3 handle, and I don't believe I'm of a similar the same view. I don't believe that the Fed is anywhere near ready to cut rates, but the market goes into these releases with this expectation that suddenly they're going to be correct. Suddenly we're going to see a dip in inflation, and the Fed's going to be cutting rates in June. Well, that's just not going to happen. So you go into these markets with equities near their highs, the dollar being sold off in the last little while, despite some very strong data last week in both the ISM and the employment number. And lo and behold, we don't get the result that the market consensus believes. So I think that we're still in a position that until the market wakes up to this and we move strongly in the other direction, then I think we're still going to get this these disappointments. I think that inflation is all of those things: persistent, entrenched, sticky, whichever one you want to pick, and that the risk of the Fed having to raise rates again, and I'm not forecasting that, has been underpriced for a long time. So I think that it's just a resetting of markets' expectations, and I think there's more of it to come.
Larry Summers was saying today the same thing as you there, Patrick, that we've got to put on the table the prospect that rates could actually rise rather than be cut.
Well, that's right, and he said that before, and I think that is it's not forecasting that rates are going to rise, but the belief in the market that there is that there's a zero probability of that, has long been wrong and continues to be shown up as being incorrect.
Andrew, I'm wondering just what the Fed can do to get inflation down, because if you look into these numbers, the things where inflation seems to be most sticky and the most stubborn parts of it are all household necessities: car and housing insurance, property taxes, shelter, all the sort of things that you got to have, you can't avoid. So how is this inflation number going to come down?
Well, the Fed has done what it could, and that is more than a year ago it hit the top at 4.5, and the only thing they can do is increase interest rates. I mean, logically. Okay, the Fed doesn't have any impact on fiscal policy. We have elections coming up in November. I don't think Biden will even remotely suggest that he's going to increase taxes or cut spending in order to bring the economy down just before he's about to hopefully be reelected. And with Trump saying that one of the first things he's going to do is get rid of Powell, well, even on a purely personal basis, I don't think Powell also is going to commit personally suicide by increasing rates. I don't want for one moment assume that Powell is going to put his own personal versus the American country's interest in front of him, but it is a consideration. And the Fed actually has a long tradition of not increasing or decreasing interest rates before or after election in a favorably direction of any of the candidates involved. So I don't think the fact that we have elections in November is going to stop the Fed from increasing interest rates should it want to. And also, there will be the extra benefit of removing the argument that Powell is a puppy dog in the hand of Biden, and he will do anything to get Biden reelected if actually Powell simply yanks interest rates before the election.
Do you both think, even if maybe a hike is not likely before the end of the year, do you think now we've got to seriously entertain the prospect that rates just aren't going to be cut at all? Forget about whether it's 3 or 2 or 1. The Fed is just not in a position, given where the economy is, the data, to be able to cut rates.
Yeah, look, absolutely, and that's where the market has been. The market has been wrong, and wrong for some time. And it's hard speaking against consensus, at times. But that's it's proving to be that it's been the correct way to be. So, yeah, look, how does inflation come down? We need higher rates. We need higher term rates. The term premium, I believe, is still too low. I think we're going to see higher bond yields. So I think we'll start to see the impact of higher rates continue to filter through the economy. Activity slows, and by activity slowing, we get prices, we get inflation. We'll start to temper. And what's needed then is higher rates for longer. So higher for longer, not necessarily up, and certainly not down. And I think that there's a very, very good chance we head into the end of the year with rates exactly where they are now, or policy rates where they are now, term rates higher.
Andrew, what do you think?
Well, it's. I have to be slightly politically incorrect here. It's like the old Jewish curse. Let not God give you what you are asking. In other words, we do get a strong American economy. We have seen relatively good, okay, labor markets. Now, we're not getting is, of course, what everybody wanted to get, and that is lower interest rates. Well, it looks as if you can't have it both ways. In other words, if the economy was weak, then it will make some sense for interest rates to be cut. It isn't, so it makes some sense for interest rates to increase. And there is really no earthly reason why the Fed will not do this. However, and that's a huge however, there is something that the Fed can do. It can actually turn around and says, look, inflation now, the 3 is the new modern. Remember a lovely title in American television series, Orange being the modern black. Okay, So in other words, that was about a jail garb. Okay, for the Fed to actually say that forget about the 2, we're not going to have a 2, we're going to have a 3. The ones that were very good in doing that were the Japanese that quietly moved slightly and then quite significantly between 2 and 3%. And they ended up with a 3% inflation as opposed to 2% inflation very quietly, and nobody noticed. So perhaps a solution for the Fed, it will be to say, once it has stabilized the 3%, then perhaps a small cut might be available. And that is, you change the goalposts. Very simple.
But it does mean, doesn't it, that whatever happens, the level that rates eventually get cut to is going to be a lot higher than people were anticipating just a few months ago.
Absolutely.
Yes, look, it was a nonsense to believe that rates were going back to where they were in, extraordinary monetary policy times. Rates are not extraordinarily high, even now, in history. And again, it's this resetting. We mentioned earlier about markets having to reset their expectations. And just as Andrew said, three is perhaps 3 is the new 2, and that can be done by just keeping rates where they are, and eventually we will trickle lower in inflation, but it's not now. The economy is still doing well, so I don't see where the danger is in not moving.
Well, Patrick, thank you very much for giving me the lovely phrase. I will attribute it to you freely, and I'll send you the 10% trademark. 3 is the new 2. I love that. That's great.
So what does this mean for markets? We've had a big repricing in the Treasury markets overnight. So the 2-year yield now is almost 5%. The 10-year yield is at 4.55%. Are these yields now at levels where they are going to be a big headwind for stocks? And should we start to expect maybe a big downward move in stocks? What do you think, Patrick?
Look, I don't think we're going to see a big down move in stocks. Obviously, we're seeing today, some tempering of what have been some extraordinary levels, but activity is still going along, moderately well. We do have inflation. We have interest rates, at moderately high levels. But no, while activity stays robust, then assets will stay robust. Notwithstanding any pricing for easing has to be taken out. So look, I think we are heading towards a level of, as I keep mentioning this resetting. But I don't see that we're going to enter a steep bear market just because this rate cut is being taken out.
Andrew, what are your thoughts? Can stocks bear the 10-year yield at 4.55%? Big jump from where it was just a couple of weeks ago.
Well, if we assume that the reason why the last 12 months has seen a spectacular move in the S&P on the basis of expectations about interest rates being cut, and if we remove these, as Patrick said, then we end up with 2 separate potential conclusions, and that is that once the market have bought that in, then the S&P should collapse. Once the markets have decided, as Patrick memorably said 3 is the new 2, then there is no reason why the S&P should not continue to be where it is. And this is a typical economist's dictum and prognostication, which tells you precisely nothing. In other words, it will either rain or it will not rain. Thereby, I'm covering myself completely. But the answer is, I don't automatically see a disaster, all right, that, oh dear, now that, this is going to be priced in. Incidentally, I am a strong believer that markets never price in anything at all. In other words, it is not true that they have priced in a cut and that's why they went up. Now they are going to price in a flat interest rate and therefore they are going to come down. I don't think that's the case. Therefore, I doubted it that the S&P is going to literally collapse back.
Patrick, what does this mean for Hong Kong? Because the Hong Kong economy is nowhere near as robust as it is the US economy, and it really does need rate cuts here, which maybe, as we've been discussing, are not going to come. What's the impact going to be on the economy here and on the markets here, which yesterday the Hang Seng did finally get back into positive territory for the year just.
Yeah, it was a short party. I hope not too many people at Petrus last night spending up on the basis of the close yesterday. Yeah, look, I think it's going to be difficult. Interest rates, as we have been at pains to point out, are staying at moderately high levels for a longer period. The outlook for China is still, is still difficult. So it's very property, especially in China and both here in the mainland and both here as well, is challenged. So it's going to be a difficult environment. The domination of the property counters has come into question for quite some time. I see them continuing to be under pressure in the near and medium term. So, again, I see Hong Kong continuing to be an underperformer, and unfortunately, that move back into positive territory may just have to wait a little bit longer.
Andrew, what do you think is the impact here?
Well, I have two dials in front of me as far as Hong Kong is concerned. One of the dials is the role of Chinese stocks in the Hang Seng Index, and I'm being told reliably that 70% of the turnover is done on Chinese stocks. And since, from the point of view of China, we still don't have anything very firm as to where the economy could be going as opposed to actually is going, okay, and since monetary and fiscal policy, we now have a pretty good idea of what's going to happen. Not a great deal of innovation, but definitely a widening of the fiscal policy side, then we cannot expect a real boom in the Chinese shares traded in Hong Kong because China is doing spectacularly well. The other point, my other calibration, is interest rates. And unfortunately, interest rates are staying high for the duration. So the whole impact in Hong Kong is not a matter of one is being negative on Hong Kong for the sake of being negative in Hong Kong or because of things happening in China. The peg simply means that our policy is determined by Powell. And Powell just told us that we're going to have still a tight monetary policy for quite a while. Never mind what happens to inflation in Hong Kong. That's completely irrelevant, of course.
The peg with interest rates at this level makes Hong Kong really too expensive, doesn't it? Which is one of the reasons why people are going to Shenzhen for the weekend and Chinese tourists aren't coming here.
Well, then if we are going to have an existential question about removing the peg, I think that it will be a really bad idea, not just because I consider the peg still has usefulness in it, but because it made to appear as some kind of a further, let's say, joint policy making with China. Thereby, there is some reason why China wants the peg removed, which I don't think for one moment China wants the peg removed. I suspect that China will give a consent to the peg being, let's say, discussed about only when the renminbi is significantly capital convertible. And it isn't for the time being. Okay, there are limitations. Once the renminbi can be traded freely, then there is no earthly reason why the Hong Kong peg may be discussed again. So, unfortunately, the peg stays, again, not only for political reasons, but also for economic reasons. And that means we are stuck with high interest rates.
Patrick, what are your thoughts? It does make Hong Kong expensive with a peg at this rate, doesn't it?
Look, it does, but look, exactly the same. I've been a long proponent that the peg is useful and will be maintained exactly until, as Andrew said, until there's capital controls are removed on the mainland. It makes no sense to even contemplate a change. But the price of having the peg, or one price of having the peg, has always been asset price volatility, because when the currency in which you're denominated in cannot move or cannot adjust, then it's the asset prices themselves that do adjust. And so that's what we're seeing now, with the Hang Seng. If the currency was freely floating, dollar Hong Kong would be significantly higher, and the Hang Seng would not be so low. But that's not going to change in the near term.
But what maybe might have to happen is that now, particularly that it's so easy to cross the border from Hong Kong over into Shenzhen, has there got to be some sort of equalisation now of costs here, of rents, of wages, to make them more in line with China? When you can freely travel now, as you can across the border very easily, it's hard to justify why Hong Kong is so highly priced compared to Shenzhen, isn't it?
Well, that's true, but that's going to take some time to adjust, and I think we could consider. It's not a perfect analogy, but the introduction of the euro back in '99, and free border travel and cheaper labour moving. Mobility of labour is a nice concept, but it doesn't but in practice it is much more sticky. So I'm not sure that that's going to happen immediately. But yes, I think this is a part of integration. It's a question that's always been around about 2047. Would Hong Kong look more like China, or would China look more like Hong Kong, or would it be some agglomeration of them both? And I think the last one is probably closer to the point. But at the moment, the costs are higher here. That's going to continue. People want to do business here because it is still a gateway into China. So that anomaly will persist.
There is also the added issue, Peter, that fluidity and mobility depends. For example, we have the huge differential between property prices, and the Hong Kong market is, given the way in which land is owned and sold, and that is, in other words, the state has a complete monopoly over that. That will need to change if property prices are going to adjust to those of China and vice versa. So that is not going to change, most definitely. Then also Hong Kong still has a fixed exchange rate, doesn't have the same currency as China. So it's no good simply saying, it's the same thing whether I spend renminbi or Hong Kong dollar. No, it ain't. Hong Kong dollar is, in inverted commas, more expensive than renminbi. And that is not going to change, or that's not going to change anytime soon in order to help Hong Kong. Mm-hmm. The yen, the renminbi is quasi-pegged by the People's Bank of China on a number of considerations, and I have my grave doubts if the relative rate of exchange to the Hong Kong dollar, in other words, the US dollar, is an important consideration, because after all, when the People's Bank of China looks at the yen and the Hong Kong dollar, and the US dollar, automatically also looks at the Hong Kong dollar as well. So there's nothing to discuss here.
Now, Fitch Ratings has cut the outlook on China's long-term foreign debt to negative from stable, citing increasing risks to the country's public finance prospects. Rising economic uncertainties and China's efforts to shift its growth model away from one driven by the property market have eroded fiscal buffers from a ratings perspective, the rating agency said on Wednesday. And it said fiscal policy is increasingly likely to play an important role in supporting growth in the coming years, which could keep debt on a steady upward trend. Now, Patrick, it is probably worth emphasising here that it isn't actually a cut in the rating itself, it's a cut in the outlook, but nevertheless, how significant is this?
Well, yes, that's right. It's a cut in the outlook, and I think many commentators would, or not many commentators would disagree with that. But in an environment, in a global environment where there's competition for capital, when it costs you more to raise that capital now in the future, which may be a result, of this, and as a result of of activity slowing, then it creates more headwinds. Fiscal policy, as again my as Andrew again was mentioning earlier, needs to take needs to lift a greater weight in the future. So I'm not sure it says anything that we don't already know. I think it alerts or re-alerts or reminds us all that the outlook for the economy remains extremely challenging.
I suppose it highlights, doesn't it, the dilemma that Beijing's got between more fiscal spending to try and boost the economy or consolidation and focusing on the fact that there is a lot of debt around at the moment.
Well, that's exactly right. Do you let things fail? And we've seen a little bit of that in the property sector, where there was the propping up of that sector, and now we've moved to, I believe, a period where we're allowed to have some fail. We're allowed to see the sector slow considerably, and that workout is going to take some time. So yeah, look, absolutely, that's part of the challenge, for the administration and the monetary authorities, and particularly that they're moving, or their circumstance for the moment are at in a different direction than is in the rest of the globe.
Andrew, I know in the past when we've talked about China's debt, you've always made the point that the debt is denominated in its own currency. It's a surplus nation, so it's never going to default on that debt. So what is the significance of what Fitch is saying here?
Well, the only thing that I possibly could think is that something may happen to the prices of the internal debt. In other words, that's really trivial. If it gets a lot more of it is around, then interest rates will have to increase. But I can't think of anything else. I find in the case specifically of China, that has a relatively small deficit as a percentage of GDP. It was about 3.2, 3.3%, and it is, I think it is forecast to go up to 3.7, which is still peanuts. Even, for example, that Japan used to have a 12% fiscal deficit. Then the internal issues are simply internal issues. It cannot possibly have any external implication, and neither will the People's Bank of China tolerate to see a collapse of the bond market, of the domestic bond market. Find it very difficult to believe that this could happen. And as you say, it is sort of robbing Peter to pay Paul, because it is money that it is domestically circulated between different state organizations, effectively, and state-owned enterprises, state-owned real assets.
China's Ministry of Finance says it regrets the decision of Fitch Ratings. What it says is that basically Fitch has focused on the negative aspects of increased debt, but failed to anticipate the positive role of fiscal policies in promoting economic growth. What do you say to that? Sorry,
Patrick, please.
Sorry, Andrew, go ahead. Yeah, look, I was going to say, they regret any prognostication from any international and any international agency. They believe that they're doing the right thing. Look, I don't take much from that. Sorry, Andrew.
Yes. People's Bank of China always has been reluctant in playing with prices, and they prefer quantity. In other words, they have no problem at all in increasing the liquidity in the market, but not simultaneously dropping interest rates. The last cut we had was, I've forgotten now, it was 3-4 months ago, and it was less than 10 basis points, nothing. It was just a gesture. So they preferred to leave the real chunky policy making, the fiscal policy, in the hands of the Ministry of Finance. And I'm sorry.
Okay, well, thank you both very much for your insights this morning. You heard there Andrew Freris, who is the CEO of Ecognosis Advisory, Patrick Bennett, who is a Hong Kong-based macro strategist.
Peter Lewis's Money Talk.
I'm joined now by Geoff Howie, who is market strategist at the Singapore Exchange. Morning, Geoff.
Good morning, Peter.
I'd like to get your reaction, first of all, to the inflation data that we had out of the US. Clearly a surprise to the upside, and the market's now completely repricing the odds of rate cuts this year. And we may well have to take into account that there might not be any rate cuts this year. If that's the case, and we have rates higher for longer, what does that mean for Singapore, for both the markets and the economy down there?
Well, it does have quite an impact, because if you look at our stock market, You have about $1 billion Singapore dollars going to work every day in it. And 25 cents or 25% of that $1 billion, or let's say, 25 cents in the dollar, goes to work in our three banks, DBS, OCBC, UOB. And they make up 2/3 of their income in net interest income, which, of course, is driven by two key things. Net interest margins, which were above 2% last year versus below 2% the year before. And those higher rates basically made the margins higher, which drove the net interest income higher. But on the other hand, if you do have these, I guess, high for longer tight financial conditions, then you do have the issue that it gets tougher to grow the loan books. So that has a kind of like a trade-off impact on the net interest income. So that's a really key important aspect of the money that goes to work in our market every day. So it's directly, basically driven by the outlook for interest rates. And I guess the other 1/3 of the income from the banks is the likes of insurance, wealth management, credit card growth, trading, etc. And of course, you need the kind of smooth transition or soft landing to be able to facilitate smooth markets and an okay outlook for consumer growth for that segment. So it's very, very related to at least 25 cents in the dollar. Another 20 cents in the dollar is directly driven by the REITs. And of course, the tighter financial conditions do cut into the net income that the REITs can actually distribute to the unit holders. So that is, I think, it's really important, Peter. It's an overarching theme that impacts multiple sectors in our market. And look, I think though Singapore didn't get caught up in the euphoria that we would have rate cuts in the first half at least. I know at the end of last year there was a lot of talk that I think we would have a rate cut in the March meeting, and we'd already be in a accommodative cycle now. But when you do modelling and so forth on that PCE core deflator, and you can go back 20 years of the monthly year-on-year data. You can look at from mid 2022 when you start having the rate started to head down from 5%. It does suggest you could have some leveling out here. There is a chance of leveling out at around the 3% level, not the 2% level. And I think that's one thing that's the Fed has found as well. And that's why 3 weeks ago, the Fed chair was saying, we might hold for a little bit more information. And that was, for me, that was giving the hint that June rate cut was off the cards, because if you look at the July timing, you look at the difference between the 12th of June FOMC and the 31st of July FOMC, you've got a period of 6 weeks, but you do have two PCE core deflator prints within the course of those 6 weeks, which meant that at the earliest you'd be looking at July anyway.
I mean, what a change, isn't it, since the beginning of the year when markets were pricing in 6 rate cuts. After the data last night, they're pricing in just 1 rate cut for this year, and then we're going to have to wait for September. And you've got some people like Larry Summers saying actually rates may have to go up. There's been a big turnaround, hasn't there?
Yeah, exactly. But I think thankfully for the US, they have had the growth, as we know. And one key thing about their wages data and the corporate earnings is that productivity is actually pretty high in the US in terms of the labor markets. And that enables, I guess, the barriers to come in to stop the wage spiraling impact, the big scary tangent that was touted a year ago or so. So you do have productivity on the one hand cutting into some of that inflation, which you don't have in Europe, you don't have in Australia. It's not easy to get that productivity factor. And what that also means is that maybe you might see a little bit of a swing in the pendulum from less focus and talk about if and when you have the rate cuts, but whether or not the US can accommodate a smooth landing. Because if there's a smooth landing that they can accommodate, that, as we said, that can help banks, particularly in Southeast Asia, across ASEAN, that have benefited from the higher net interest margins. But if you do have the smooth landing, then some of that loan growth can start to come in and offset what might be just flat growth in net interest margins per se.
Now, when we spoke at the end of December, we looked at the 5 major Southeast Asian markets, and we thought that maybe, this year was going to be a good year for them because they were looking quite cheap. There were some good fundamentals in place. If we now look at the end of the first quarter, Singapore, the Straits Times, completely flat by the end of the first quarter. Similar story in Jakarta and Thailand as well, barely moved. The two that have moved, Philippines, the PSCI is up 4.5%. Malaysia, the KLCI, up 6.8% at the end of the first quarter. What's the outlook looking like going forward from here?
It's really interesting, right? This is 2024. The GDP for all combined ASEAN, not just the 4 or 5, but all the 10 member states, is about $4 trillion or fast approaching $4 trillion. We're expecting high 4% growth this year. It's pretty dynamic. And the thing is, some of the countries that are growing significantly with the highest growth rates and also having that parallel with extended performances that are outpacing the region in the stock market have, of course, been Vietnam and the Philippines. In fact, Peter, Vietnam, our SGX Vietnam futures are now doing more trading turnover than the SGX Indonesian futures, but both indices powered by FTSE. I think what's happening here is, like we said at the end of last year, you have those 3 very pivotal strategic initiatives. You have digitalization across the region, the pivot towards sustainable solutions, and you have this ongoing regional integration. Now, those 3 factors provide the ongoing structural growth drivers. But for this year, your immediate focus is really on the impact on the recent turnaround in manufacturing and trade, reviving the tempo of some of our consumer markets and services, and of course the pending reprieve in US Fed fund rates. So there's multiple factors. What might be offsetting some of the high rates for longer is the growth we've been seeing in trade and manufacturing. The S&P Global ASEAN Manufacturing PMI actually showed our manufacturing conditions across ASEAN improved for a 3rd consecutive month in March, and that PMI has actually now ticked up to an 11-month high of around 51.5. New orders for March rose, I think, for the first time in 7 months, and that rate of expansion for new orders was the fastest since mid-2023. Now, that wasn't on the back of international orders. That was more domestic demand within ASEAN. So as long as the inflation continues to decline, and expect to moderate around 3%. I think you've got banks just watching, central banks just watching very carefully. Philippine Central Bank met this week. They kept their rate at 6.5%. Bank of Thailand met yesterday. I think they released their at 3 p.m. Hong Kong time that they didn't change their policy rate from 2.5%, despite the government wanting them on the amount of household debt there. And then tomorrow, the MAS has its policy meeting, and it's also expected to stand pat and not change the slope of its Singapore nominal effective exchange rate. So that in effect shows you and relays that things are moving along, I guess, not as strong as we want, but obviously smoothly as the central banks are standing pat, and the manufacturing numbers are also starting to tick up.
And how important is the inbound investment that we're seeing into some of these countries? Because that's quite significant at the moment, isn't it? As countries look to diversify their supply chains, and maybe particularly Malaysia, it's getting a lot of inbound investment in the technology sector, people setting up, companies setting up manufacturing facilities, fabs in Malaysia. Is that a big impact?
Yeah, I mean, you're 100% correct. As I said before, Vietnam and Philippines have led the region, but Malaysia is also among those two. So it's Vietnam, Malaysia, and the Philippines that have led the region. So that is right. Technology. You see, this is the thing. It's been the strongest component across our ASEAN All-Share Index, FTSE ASEAN All-Share Index, which has about a $2 trillion market cap. All the ASEAN's basic index stocks, you're talking about 1,000 stocks in total. You've got a technology component there It's up 33% in US dollar terms since the end of 2019, but it only makes up 3% of the index. Vietnam's FPT Corporation, I think, is the largest tech play in that index, market value of about $6 billion US dollars. It's chalked up 15% gains in the year to date. And by country, as we said, Vietnam has been the strongest performing since 2019, just as Vietnam has been outpacing ASEAN GDP. So when you look at the past performance of these indices by sector and tech, you have seen that theme that you've just brought up actually work through into the market. It's just not so terribly evident in the performance of the broader benchmark due to the small weighting.
And should investors regard these markets as being a bit of a safe haven this year, in the sense that Southeast Asia is insulated from some of the problems that we're seeing, such as the war in Ukraine and the Middle East, the geopolitical tensions between the US and China?
Yeah, you know what? You're right, because, well, it has been so in the past, because those structural drivers that I mentioned before, they are pretty significant, pretty solid, overarching pillars, if you will. Digitalization has a significant impact in financial services, for instance. So there's a lot happening on the long-term drivers. And also, when you look across the sectors that have outpaced this year, it's energy, it's utilities, it's industrials, it's basic materials sectors, it's financial services on the back of that digitalization as well. So your longer-term drivers, I guess, and having these intrinsic growth themes in the region do provide somewhat of a little bit of insulation from some of the big global overarching macro drivers.
And what are valuations looking like?
Yeah, I mean, quite competitive. It's interesting, right? The banks are obviously very competitively valued. And if you look at the next performing sector, best performing sector we've had this year, it's telecommunications. The three biggest, most traded stocks, Singtel, StarHub, Netlink, NBN Trust. When you look at their valuation, their average price to book valuation, it's exactly in line with global telcos. So they do remain competitive. The only issue is, when they are remaining so competitive, is that when you have a tidal effect like we've seen in the global REIT market, that can also impact the valuations here at home, even though the outlook for home might be a little bit different to what you're seeing across the globe.
Geoff, thank you very much indeed. Always good to talk with you.
Absolute pleasure. Thanks so much, Peter.
That's Geoff Howie, who is market strategist at the Singapore Exchange.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on developments during the Asian trading day. I'll be back with another programme tomorrow, the final Money Talk of the week, when I'll be joined by Francis Lund, the CEO of Geosecurities, and Frederick Chew, Managing Director of Magnum Research. And with a view from Australia is Toby Lawson, the CEO of Staten Partners. Have a good day.
Money Talk